Okay, you shared some really interesting stuff with us, getting right into the details of intermediate accounting.
Yeah, it can get pretty complex.
So for this deep dive, we're really aiming to, untangle some of that complexity around investments and liabilities. We'll be using these excerpts from Intermediate Accounting 2, that quick study guide.
Exactly. And the goal is really to make these concepts clearer, easier to grasp their importance in the real world.
Right. We're hitting two main areas today. First up, investments, how companies classify them, and, well, why it matters.
And second, we'll tackle liabilities, current versus non-current, what makes them different, and how they tell a story about a company's financial situation.
We want to give you a solid, practical understanding of these key reporting pieces.
Precisely.
Now, it helps if you have some background from intermediate accounting, the conceptual framework, balance sheets, income statements, that kind of thing.
Yeah, that's the foundation we're sort of building on today.
But we're not starting from scratch. This isn't Accounting 101 revisited.
Definitely not. Okay, so where should we start? Investments.
Let's do it. Investments. How do companies account for owning bits of other companies?
Well, broadly speaking, you've got two main types. There are debt securities, think bonds and notes, essentially loans.
Right, with a principal amount, an interest rate, and a date when it gets paid back, the maturity date.
Correct. Then you have equity securities, that's ownership common and preferred stocks.
And with equity, it starts with what they paid, right? The cost.
Usually, yes, they're recorded at cost initially, but here's a key thing. If there's a quoted market price readily available, like on a stock exchange.
Then you update it.
Exactly. You adjust the value on the books to reflect its current fair value. If there's no easy market price, it just stays at cost until it's sold.
Okay. But the classification, that seems crucial, especially when the investing company doesn't have, like, major control.
Absolutely critical. Accounting standards set out three main buckets here: held to maturity, trading, and available for sale.
And the choice depends on what the company plans to do.
Plans and ability, intent and ability are key. And each category has different rules for reporting, especially for those unrealized gains and losses, the paper profits or losses.
Okay, let's break those down. Held to maturity first. What's the story there?
The name gives it away, really. These are debt securities only, bonds or notes. The company has to intend to hold them until they mature, and they also have to have the ability to do so.
So no plans to sell early.
Right. And on the balance sheet, these are reported at something called amortized cost.
Amortized cost, meaning
It's basically the original cost adjusted over time. This comes into play if you bought the bond for more or less than its face value, a premium or a discount.
okay, and those paper gains or losses, the unrealized ones.
Interestingly, they don't hit the income statement for held to maturity. They're just not recognized in income.
So no impact on reported profit for market swings.
Not directly in net income, no. But the fair value is usually disclosed in the notes to the financial statements. So the information's there, just not on the main income statement line. It signals a low-risk, long-term approach.
You mentioned premiums and discounts. Can you give a quick example? Like buying above or below face value?
Sure. Well, let's say a company buys a bond. Face value is $1 million, but they pay $1.1 million for it.
Okay, so a $100,000 premium. Why? Maybe higher interest.
Probably, yeah. A better than market stated interest rate. So that $100,000 premium isn't expensed immediately. It's gradually reduced over the bond's life, which actually lowers the interest revenue reported each period.
And the flip side, a discount.
Right. Same $1 million face value bond, but maybe they buy it for $750,000. That's a $250,000 discount.
Because the stated interest is maybe lower than the market rate.
Exactly. And that discount is added to interest revenue over the bond's life. It all uses something called the effective interest method to make the revenue recognition reflect the true economic yield.
Got it. Hold till maturity, amortized cost, no unrealized gains, losses, and income. Okay, what about trading securities? Sounds much more active.
Totally different mindset. Trading securities can be debt or equity are bought with the main goal of selling them pretty quickly.
Like day trading, but for companies.
Sort of, yeah. Trying to profit from short-term price fluctuations. They're usually classified as current assets because the intent is near-term sale.
And cash flows. Where do they show up?
It depends. For banks and financial institutions, it's often operating activities. For other companies, it's typically investing activities, unless the sale is, like, really soon.
Okay. And how do these show up on the balance sheet and income statement? This must be different.
Big difference. They start at cost, like the others, but then at every reporting date, end of quarter, end of year, they're adjusted to their current fair value. Marking to market, they call it.
Marking to market, so reflecting the current price.
Exactly. And here's the kicker. Any unrealized gain or loss, the change in value, even though you haven't sold it yet, goes directly into net income for that period.
Whoa, okay. So market ups and downs hit the bottom line immediately.
Immediately. It makes the income statement more volatile, reflecting those market swings directly.
Can you show us how that works? A quick example.
Sure. Company buys a trading security for $100,000. End of the quarter, its market value is down $10,000, so it's worth $90,000.
Okay.
That $10,000 decrease, it's recognized as an unrealized loss, reducing net income for that quarter.
And if it goes up next quarter, say by $20,000.
Then that $20,000 increase is an unrealized gain, boosting net income in that next quarter. It directly tracks the market movements in reported profit.
Okay. Trading. Short-term intent, fair value, unrealized gains, losses, hit net income.
Got it.
That leaves the middle category. Available for sale. Where do these fit?
Available for sale, or AFS, are kind of the catch-all. They aren't held to maturity because there's no definite plan to hold them forever, but they also aren't trading because the primary intent isn't rapid resale.
So maybe you'll sell, maybe you won't, depending on needs or market conditions.
Exactly. It's more flexible. The company could sell them if needed, but they're not actively trying to trade them day to day. Cash flows from buying and selling AFS are classified as investing activities.
And the accounting, how does it compare to trading? Fair value again?
Yes, fair value on the balance sheet, just like trading securities. They start at cost, then get marked to fair value each reporting period.
Okay. So what's the difference then?
The big difference is where those unrealized gains and losses go. For AFS securities, they do not go into net income.
Ah, okay. So where do they go?
They go into other comprehensive income, or OCI.
OCI. That's part of equity, right? But separate from retained earnings, which comes from net income.
Exactly. OCI captures certain gains and losses that bypass the regular income statement but still affect the company's overall equity. Think of it as a holding area for these value changes until the investment is actually sold.
So it impacts the company's net worth, but not its reported profit for the period. Can we do the same example?
Yep.
A $100 K investment?
Sure. Buy an AFS security for $100,000. Value drops by $10,000. That $10,000 unrealized loss goes to OCI, reducing total equity but not net income.
And if it then gains $20,000?
That $20,000 unrealized gain also goes to OCI, increasing equity. Still no impact on net income for that period.
Until you sell it?
Precisely. When you finally sell the AFS security, you take all those accumulated unrealized gains or losses that were sitting in OCI and you recycle them, you move them out of OCI and recognize them in net income at that point, along with any additional gain or loss from the sale itself.
Okay, that distinction between net income and OCI is really key for trading versus AFS. Super helpful. But what if a company changes its mind? Can they switch an investment between these categories?
Good question. Yes, transfers can happen if the intent genuinely changes, and the accounting gets a bit specific depending on which way you're transferring.
Like going into trading.
Right. If you transfer something into the trading category from either held to maturity or AFS, any unrealized gain or loss that exists at that moment generally gets recognized in net income immediately.
Okay, so moving to trading triggers immediate income recognition. What about moving out of trading?
If you move from trading to either held to maturity or AFS, the security is transferred at its fair value on that date. Any gain or loss up to that point would have already been in net income because it was trading.
Makes sense. And say, from held to maturity to AFS.
Okay, held to maturity to AFS. The unrealized gain or loss at the transfer date goes into OCI.
And AFS to held to maturity.
For that one, the unrealized gain or loss that was already sitting in OCI stays in OCI. But then it gets amortized out of OCI and into net income over the remaining life of the security, similar to how bond premiums or discounts are handled.
Wow, okay, so the path it takes through the financials really depends on the direction of the transfer. Now, there was also mention of a fair value option. What's that about?
Ah, yes. The fair value option gives companies some flexibility. For many types of financial assets and liabilities, they can choose right at the beginning when they acquire it to just account for it at fair value.
Instead of following the held to maturity or AFS rules.
Exactly. If they elect this option for a specific item, they just report it at fair value on the balance sheet, and all changes in fair value unrealized gains and losses go straight into net income.
So it's like treating it as a trading security, even if it isn't technically held for trading.
Pretty much, yeah. It simplifies things in some ways, but brings more volatility into net income. It's an irrevocable choice made item by item.
And those levels of fair value disclosure, level 1, 2, 3? What's the quick version of that?
It's about transparency. How reliable is the fair value number? Level 1 is best. Uses quoted prices from active markets for identical assets. Think stocks on the NYSE.
Okay, clear market price. Level 2.
Level 2 uses other observable inputs, maybe prices for similar assets or interest rates, things you can see in the market but aren't a direct quote for the exact item.
Right. And level 3.
Level 3 is based on unobservable inputs.
Hmm.
The company has to use its own assumptions, maybe discounted cash flow models, things like that. It requires more judgment and more disclosure.
Got it. Hierarchy of reliability. Okay, one last thing on investments before we switch. The equity method. That's for more significant ownership, right?
Right. Generally, if you own between 20% and 50% of another company's voting stock, you're presumed to have significant influence.
Not control, but influence.
Exactly. And typically, you use the equity method. Your investment account goes up or down based on your share of the investee's net income or loss and decreases when they pay you dividends.
But the fair value option could still apply here.
Yes, interestingly, even if you have significant influence and would normally use the equity method, you can still elect the fair value option for that investment. If you do, fair value changes go to net income, just like we discussed.
Okay, that covers investments pretty thoroughly. Let's shift gears to the other side. Liabilities. Starting with current liabilities. What's the basic definition again?
Current liability, an obligation the company expects to settle within its normal operating cycle, or 1 year, whichever is longer.
And usually using current assets.
Usually, yes.
Oh.
Or by creating another current liability.
Okay. First on the list in our source. Accounts payable. Pretty common, right?
Super common. This is money owed to suppliers for things bought on credit inventory, supplies, services, utilities, usually short-term, often no interest if paid on time.
And the gross versus net method for discounts.
Right. 2 ways to handle purchase discounts offered for paying early. Gross method. Record the payable at the full invoice amount. If you take the discount, you record it then as a reduction in purchases or inventory cost.
And net method.
Net method assumes you will take the discount. So you record the payable at the lower discounted amount right away.
What if you don't take the discount then?
Then you have to record an expense for the discount lost. It highlights the cost of not paying early.
Interesting contrast. The source also mentions net settlement value. What's that?
It's just the straightforward amount of cash expected to be paid. Current liabilities are typically measured at this undiscounted amount.
Okay. Next up, accrued expenses. What falls under this?
Accrued expenses are costs the company has incurred. They've received the benefit, but they haven't actually paid the cash yet by the end of the accounting period.
Like salaries earned by employees but not paid until next month.
Exactly. Salaries payable is a classic example. Also, interest that's built up on a loan but isn't due yet, interest payable. Income taxes that relate to the period's earnings but won't be paid until later, income taxes payable. These usually require adjusting entries to get the expense into the right period.
Makes sense. Matching the expense to the period it was incurred. What about taxes payable more generally?
This covers various taxes owed to governments. Besides income tax, think sales taxes collected from customers that need to be remitted.
So a company collects it but owes it to the government.
Right. It's a liability until paid. Also, property taxes accrue over the year. Federal unemployment taxes, state taxes, various obligations, usually current.
Okay. Another one, unearned revenue. Getting paid up front. How's that a liability?
Because you owe something in return. Unearned revenue, or deferred revenue, happens when a customer pays you before you deliver the goods or perform the service.
Like a magazine subscription paid in advance.
Perfect example. Or a retainer fee for services not yet rendered. You have an obligation to either provide the service or give the money back. It's a liability until you earn it by doing the work.
And it's current if you expect to earn it within the next year or operating cycle.
Typically, yes. If a $120,000 advance covers services for a full year, initially it's all unearned. After, say, 5 months, you'd recognize 512ths or $50,000 as earned revenue, and the remaining $70,000 is still a liability.
Got it. Okay, warranties are mentioned too. How are future repair promises a liability now?
They're treated as loss contingencies. If a company offers a warranty, it's probable they'll incur some costs fixing or replacing products later.
So you have to estimate those future costs.
Yes. If the future costs are probable and you can reasonably estimate the amount, GAAP requires you to record an estimated warranty expense and a corresponding warranty liability at the time of the sale.
Wow, so you book the expense before the actual repairs happen.
Exactly. You match the estimated cost of the warranty with the revenue from the sale it relates to. For example, sell a $1,000 product, estimate $40 in future warranty costs. You debit warranty expense $40 and credit estimated warranty liability $40 right then.
And when a customer actually comes in for a $30 repair under warranty later,
Then you debit the estimated warranty liability for $30, reducing the liability, and credit cash, inventory, or wages payable, depending on what the repair cost was.
okay, that makes sense. Estimating future obligations. What about current maturities of long-term debt? This sounds like a crossover.
It is. You might have a 10-year bond or a 5-year bank loan, clearly long-term debt, but the portion of that principal that's due to be repaid within the next year or operating cycle gets reclassified.
From non-current to current liability.
Precisely. So that 10-year bond, in its final year before maturity, the entire remaining principal becomes a current liability. Also, importantly, if debt is callable by the lender within the next year, meaning they could demand repayment, even if they don't plan to, it usually has to be classified as current too.
So it reflects the near-term demand on cash. Okay, last one, undercurrent. Income taxes payable. We mentioned it under accruals, but any more complexity here?
Yeah, this is where deferred taxes often come in. Income tax payable is what you owe the government based on the tax return, calculated using tax rules. Income tax expense on your income statement is based on your book income, calculated using GAAP rules.
And those rules can differ.
Often they do. You have permanent differences, which never reverse, and temporary differences, which do. Temporary differences are the big drivers of deferred taxes.
Like using different depreciation methods for book and tax.
That's a classic example. If your depreciation for tax is faster than for book, your taxable income is lower now, but it'll be higher later when the difference reverses. This creates a deferred tax liability. You'll owe more tax in the future.
And the opposite. If taxable income is higher now than book income.
That can create a deferred tax asset representing a future tax deduction or saving. Think of warranties. You expense them for book when estimated, but only deduct them for tax when paid. That creates a deferred tax asset.
And companies have to assess if they'll actually realize those future benefits.
Yes, especially for deferred tax assets, there's a valuation allowance concept. If it's more likely than not that some portion of the deferred tax asset won't be realized, you have to record an allowance to reduce it.
Okay, quite a bit involved there. That gives us a good feel for current liabilities. Can we briefly touch on the major types of non-current liabilities?
Sure. These are the longer-term obligations. Bonds payable are a huge one. Companies issue bonds to borrow large amounts, usually paying semi-annual interest at a stated rate, and repaying the principal at maturity, often many years down the road.
And they can be issued at par, discount, or premium, like we discussed with investments.
Exactly. The accounting mirrors that, but from the issuer's side. Any discount or premium is amortized over the bond's life using the effective interest method, affecting interest expense. Also, costs to issue the bonds, like legal and printing fees, are typically recorded as an asset and amortized over the bond's life too.
Okay, bonds. What else is significant in non-current?
Non-current notes, payable things like long-term bank loans, mortgages. Accounting is often similar to bonds, using effective interest. Some notes are installment notes, where each payment includes both interest and some principal reduction.
Right. Then there are asset retirement obligations, AROs. Those sound specific.
They are. These are legal obligations tied to the retirement of a tangible, long-lived asset. Think decommissioning a nuclear plant or restoring land after strip mining.
You have to estimate that future cost.
Yes, estimate the fair value of that future obligation, record it as a liability now, and also capitalize that same amount as part of the asset's cost, called asset retirement cost, or ARC. Then you depreciate the ARC and accrete interest expense on the ARO liability over time.
Complex. What about leases?
Leases are big. Historically, we distinguished operating leases, like simple rentals, from capital leases, more like purchases. Under newer standards, ASC 842, most leases result in recording a right-of-use asset and a lease liability on the balance sheet.
So fewer off-balance sheet leases now.
Generally, yes. Leases meeting certain criteria, like transferring ownership, long lease term relative to asset life, present value of payments covers most of the asset's value, are classified as finance leases, similar to old capital leases, others as operating leases, but both generally involve putting an asset and liability on the books.
And pensions. Always sounds complicated.
Pensions, especially defined benefit plans, are complex. These promise a certain level of benefit to employees in retirement, often based on salary and years of service. The company bears the investment risk.
Unlike defined contribution, like a 401k.
Right. Defined contribution is simpler. The expense is just the contribution made. Defined benefit requires actuaries to estimate the future obligation, the projected benefit obligation, or PBO. You compare the PBO to the fair value of plan assets set aside to pay the benefits.
And the difference is a net pension liability or asset.
Correct. And the annual pension expense itself has multiple components: service cost, interest cost on the obligation, expected return on plan assets, amortization of past service costs, and actuarial gains losses. It's a whole separate area of accounting.
Definitely sounds like it warrants its own deep dive. Maybe just a quick word on contingencies.
Sure, contingencies are potential future gains or losses whose outcome depends on a future event. For loss contingencies, like lawsuits or warranties, if the loss is probable and the amount can be reasonably estimated, you must accrue it record an expense and a liability.
Like the warranty example. What if it's only reasonably possible?
Then you disclose it in the footnotes, but don't record a liability. If it's remote, usually no disclosure is needed, unless it's a guarantee of someone else's debt.
And gain contingencies.
You generally don't recognize gain contingencies until they are actually realized or realizable. Conservatism principle at play.
Okay, we've covered a massive amount of ground here. We've gone from investment classifications, held to maturity, trading, available for sale, the fair value option.
Right, focusing on intent, fair value versus cost, and whether those value changes hit net income or OCI.
All the way through current liabilities like payables, accruals, unearned revenue, warranties, taxes.
And touched on the big non-current ones: bonds, notes, AROs, leases, pensions, contingencies. Understanding the timing and nature of these obligations is just critical.
Absolutely. It really highlights how accounting rules try to capture the economic reality of a company's situation, its strategies, its future commitments.
And seeing the differences, like fair value versus amortized cost or net income versus OCI impact, shows how different choices can present a different picture, even for similar underlying economics.
Which leads to a great question for you, the listener, to think about. If you're looking at two companies that seem pretty similar on the surface, but one uses the fair value option extensively for investments, while the other sticks to AFS and held to maturity, or maybe one has significant pension liabilities while the other uses defined contribution plans. How would you analyze them differently?
Yeah, what do those different accounting choices or liability structures tell you about their potential risk, their earnings quality, their future cash flows? It's something worth mulling over.
This deep dive really gives you that solid foundation, hopefully, to start asking those kinds of questions. We definitely encourage you to dig back into your source material on any areas that caught your attention.
For sure. There's always more detail to uncover.
And that wraps up our exploration today of investments and liabilities in intermediate accounting. We hope this clarified some key concepts and their importance. Join us next time for another deep dive.